Royalty companies.
Money, money, money.
No, not music royalties. After my Uranium 2 video, many took me up on the suggestion to cover royalty companies in more detail. As there is only one royalty company within the uranium space currently, UROY, I'm going to take a two-pronged approach in this video. We will talk first about royalty and streaming companies and why they are interesting to invest in, and then we will look at some interesting royalty companies across the commodities space and apply this theory also to oil and precious metals. And then an interesting surprise in the end. I'm trying to educate here. If you want someone to tell you what to do, there are plenty of people on the internet who will happily do that. I'm not one of them. Because I've yet to meet a single successful investor who stays successful by copying someone else. Only own education, own knowledge, own decisions work. I have learned a lot preparing for this video, and I hope that you will learn something also. And to maintain the highest degree of ethics. Around the time of publishing this video, I don't carry any exposure to any of the companies mentioned in this video, neither long nor short. So royalties and streams. There are many definitions, but I like the one best given by Rick Rule, a very successful investor and speculator in the resource commodity sector. His definition is that the royalties and streams are financial instruments, and royalties involve the royalty owner receiving from the property owner a fixed percentage of the output, or sales proceeds from the output, without any financial liability. To remember, this one is then your gross is your net. A stream is different. Then you pay for a specific amount of the product at a specific price over a specific amount of time. Say 1,000 ounces of gold over a specific time. So this one is the risk-adjusted NPV, net present value. In the natural resources sector, royalties and securities make a lot of sense. They take away most of the downside, which means that upside can be less as well. But the fact that my gross is my net, and that I'm not responsible for ongoing sustaining capital investments or project investments is attractive. They are also unconstrained by operating costs, except for a handful of employees they employ. In the case of royalties, on very large projects, your returns are uncapped. There is significant upside as very large deposits often generate positive surprises. The typical life you put into the calculation is 15 years, while the actual mine life is in most cases historically have been 35 years plus. So there is that potential upside for many years, at least looking at the historical facts. Another advantage of royalties is what I said in the previous video. If you are a uranium producer, for example, when costs of production is increasing, for example now when oil prices are going up, while uranium price is also going up, your overall profit may not increase, resulting in a flat share price. Royalties and streaming companies, on the other hand, do not have that issue, as they are purely getting their uranium at an increased valuation. Now it gets very important to understand the causality, the relationship between cause and effect. In a high inflationary environment like we're in now, energy becomes very important. For everyone, nations, companies and individuals too. And as we can see here, oil has been pushed back hard. Here we have coal, gas, hydro, nuclear, wind, solar, other renewables and oil. But this could pick back up soon. Look at the situation in Germany, for example. First, they wanted to use solar in a country much like Sweden, where there isn't that much sun. And also, solar doesn't have the ability to provide continuous electricity and struggles a little to deal with the typical peaks and valleys in demand of electricity. And now that the gas is turned off, there is a real issue here. This is now being addressed by coal and shipping gas, oil, wood and other sources of energy to Germany from, for example, the US. Also, while there is an embargo from the West to Russia on providing their oil, Russia is happy to sell it to the Chinese and the Saudis, who are then happy to sell it with additional margin back to Europe. The world is moving towards more and more electricity, while seemingly not quite realizing that you typically need to store that electricity in batteries at some point for that to work. And the demand for all kinds of battery metals can far outstrip production capacity. And that's simply perhaps not feasible to solve in the short term. And this in turn might put back focus on fossil fuels, which are currently being underinvested because the trend looks like this: who wants to invest in a downtrend? Historically, we've always added energy sources to the pie. We never removed them in terms of absolute quantity. For example, coal, even when we started using more dense form of energy. In fact, use of coal increased. And now with nuclear being relabeled as green and being the densest form of energy, uranium is one of my focus areas, because it's perhaps the only feasible way to produce enough electricity which isn't fossil based, which creates other problems. If you want to dig deeper into what is myth and what is fact, I recommend my OG energy crisis video here. After this video, I'll link it below. Oil is primarily not used for electricity production, but it is required for a lot of things. To make diesel, to make agricultural fertilizer, and because of all the green initiatives, a moat has been created around the companies operating in this space, due to additional taxes, removal of incentives, and so on. However, the transport of the diesel, oil, gas must still happen, and probably must happen even more today than it did a few years ago, while this industry is kind of on its knees. Note I'm talking about all of this from an investment opportunity standpoint, not any other perspective of what I think is good or bad for the planet. That I covered in this other video. Coming back to the main point. Energy prices are rising, and I think we can expect them to rise for longer, especially once China opens up from the lockdowns they are currently enforcing on their population and start to become a productive society again. Then those higher diesel costs must be paid by the mining companies digging for gold, silver, copper, uranium and so on, because mineral extraction is very energy intensive. Then even though prices for the minerals go up, the profit margin for the mining companies could largely or potentially fully be eroded by the increase in the cost of their energy. Let me illustrate this with an example based on a pretend company. So this company mines for gold. Price of gold today is about $1,800 and the chart looks very interesting. Let's say 2,000, so it's easy to calculate. Then let's say that their all-in cost for production per ounce is 1,900. Just example. And say they produce 100,000 ounce. So $100 in profit, they make 10 million in earnings. We ignore the tax for the moment. And with a PE ratio of 10, their market cap is 100 million. Now let's assume that this cup and handle here confirms. And we get a massive rally in gold, which runs up to 4,000. Doesn't seem unreasonable from this chart. Then look at this. Gold price 4,000 per ounce. 100,000 ounces. We have $210 million in earning. With the same PE ratio, the market cap is now $2.1 billion. 21x. Nice! While gold as such only in quotation mark went 2x. So owning shares in the gold company instead of owning gold as such can be a leverage on the underlying asset. But now we have a situation where costs are increasing as well, for example due to higher energy costs. So maybe they make only $500 per ounce. Then the earning is $50 million. With the same PE ratio, the market cap is 500 million. So 5x, still nice, but way less than 21x. So if this is your bet and you want to disconnect the cost, that's where the royalty company comes into play, because then what happens to this cost column is completely irrelevant, and the potential impact of the market cap of the royalty company can come closer to this effect. So to sum this up, without having to form an opinion here whether there is a need to own physical gold, the stock of company X here provided leverage on the gold price. But if the increased cost of diesel substantially increases the OPEX of that company, that means that the share price of that company probably would not go up as much. But if we take a royalty company which owns a substantial royalty of this company, it is not affected by those costs. It receives a fixed amount of gold every 3 months or whatever at an ever-increasing price, and thereby having potentially bigger positive impact on their share price. Of course, this is a simplified example, and of course, market speculation is never easy. If something is obviously the case, it's already priced in. But we need to at least understand the mechanics to outperform those who don't. Next we will look at a few royalty companies which could be of interest. And remember now that the concept of royalty companies has been around in the oil industry for quite a while already. And they are in many cases better run than the mining companies. But first we will highlight an acquisition by Uranium Royalty Corp, the same one I showed before. So a few notes here. They will receive physical uranium, so they can sell it whatever way they want to maximize value to the shareholders. And number 2, they acquired a royalty on uranium production from the Dawn Lake project in the Athabasca Basin region in Canada that you remember from the previous video. Royalty companies exist in most industries. An example here is Franco-Nevada in the precious metals space. Here's an overview of some royalty companies in the oil and gas industry. Some other companies on my radar: freehold royalties, mineral titles and royalties on oil and gas properties across North America, Arc Resources, properties in Montney in Canada. And within the gold and silver space, there are also a couple of interesting royalty companies that I think are worth to mention. The first one being Gold Royalty Corporation. While this one is trending down, if this one breaks up here, we get a solid double bottom in this chart. So that would really be an entry opportunity to look out for. Another way could be if this continues in a range. An entry at support is never wrong, because once again you can control the downside. Here's another one, Osisko Gold Royalties, and this chart is really interesting too, because as you can see here, there is this resistance area here. If we collapse a little, it becomes very clear. If price manages to break up above this resistance area, that's a clear bottom pattern, a clear complex head and shoulders formation. So another interesting chart that I'm showing you before it has actually happened. Then we have Sandstorm Gold, New York Stock Exchange, and this one also charts very well. We've had this big up move, then price is painting a flag, which is a bullish pattern. Tried one breakout, didn't work, back to channel support, but a solid breakout from here in an uptrend like this could be very productive from a technical analysis standpoint. Next one, Wheaton Precious Metals. Again, very interesting chart. Have this rounded bottom, managed to break out, fell back, got back up, doing another handle-like formation. And to not overcomplicate this, I think we should see this as there's a resistance area, a solid breakout would turn this into a very productive chart. And in terms of trend, I'm going to do a deeper study with more data on which time frame exactly is optimal to catch these trends, so stay tuned for that. Then there's a recent royalty acquired by Metalla Royalty and Streaming in the gold space. This company, First Majestic, is a very prominent silver mining company, and they shared this on the 28th of November. You can see the specific royalty assets in the table, and it includes 100% gold royalty up to a maximum of 1,000 ounces per year at La Encantada, which is currently in operation, with all the other assets either in care and maintenance or in the exploration phase. La Encantada is mostly a pure silver mine, but it does produce a small amount of gold each year. And over the past decade, it averaged around 200 to 250 ounces per year. Not all that much to the operation, and certainly not valued in the market. Now, First Majestic can perhaps better unlock the value with this deal. And with the recent weakness in the equity market, it probably made a lot of sense to try to push ahead and capitalize on this probably undervalued gold opportunity. Just as an example. Here's another one, Carbon Neutral Royalty. That's a newly formed royalty company which is starting up in the carbon space. They are currently private, but they are proposing an interesting business model where they finance projects that remove carbon from the atmosphere in return for carbon credits, which they can then monetize. And they are planning projects like mangrove restoration in Myanmar, which is very close to my heart. Because, you know, there is this incredible invention that takes CO2 molecules out of the air and put them back underground, reversing the fossil fuel disaster. It's called a tree. It's amazing. None of these companies are an endorsement, just sharing what I'm researching, what I'm learning myself. Please subscribe. Thank you, tack. City och Lars Natt. Hej då.